Topic introduces swaps and options, two important categories of derivative instruments widely used in financial markets for hedging, speculation, and portfolio management. Derivatives derive their value from underlying assets, rates, or indexes, allowing market participants to transfer and manage financial risk efficiently. Swaps involve the exchange of cash flows between counterparties according to predetermined terms, while options provide one party with the right, but not the obligation, to buy or sell an underlying asset at a specified price before or at expiration. Understanding swaps and options is essential because these instruments play central roles in modern risk management and investment strategies. Swaps are over-the-counter derivative contracts in which counterparties exchange a series of future cash flows. Interest rate swaps are among the most common forms, allowing one party to exchange fixed-rate payments for floating-rate payments based on a notional principal amount. For example, a borrower with floating-rate debt may enter into a swap to obtain fixed-rate exposure and reduce uncertainty regarding future interest payments. Currency swaps involve exchanging principal and interest payments denominated in different currencies, helping firms manage foreign exchange exposure. Because swaps are privately negotiated OTC contracts, they provide flexibility but also expose participants to counterparty credit risk and liquidity considerations. Interest rate swaps provide important benefits for financial institutions and corporations seeking to manage borrowing costs and balance sheet exposures. Firms may possess comparative advantages in certain borrowing markets and use swaps to transform liabilities into preferred interest rate structures. For example, a company with fixed-rate debt but expecting declining interest rates may swap fixed payments for floating-rate payments. Conversely, a borrower seeking stability may exchange floating-rate obligations for fixed-rate exposure. Swap pricing depends on prevailing interest rates, expected future rates, and counterparty credit risk. Since swaps involve ongoing exchanges over time, changes in market conditions can significantly affect the value of outstanding contracts. Options differ fundamentally from forwards, futures, and swaps because they grant asymmetric rights and obligations. A call option gives the holder the right to buy an underlying asset at a specified exercise price, while a put option gives the holder the right to sell the underlying asset. The seller or writer of the option assumes the corresponding obligation if the holder exercises the contract. Option buyers pay a premium for these rights, limiting potential losses to the premium paid while allowing potentially significant gains if market movements become favorable. This asymmetry makes options valuable tools for hedging downside risk and implementing directional trading strategies. Several factors influence option values, including the underlying asset price, exercise price, time to expiration, interest rates, volatility, and expected dividends or cash flows. Higher volatility generally increases option value because greater price uncertainty raises the probability of favorable outcomes for the option holder. Longer time to expiration also tends to increase option premiums because additional time provides more opportunity for profitable price movements. Options may be exercised only at expiration, known as European-style options, or at any time before expiration, known as American-style options. These structural differences influence valuation and trading strategies within derivatives markets. Topic ultimately demonstrates that swaps and options are versatile derivative instruments supporting risk management, investment flexibility, and market efficiency. Swaps enable counterparties to exchange financial exposures and customize interest rate or currency risk management strategies. Options provide asymmetric payoff structures that allow investors to hedge, speculate, or enhance portfolio returns with controlled downside exposure. Although these instruments offer substantial benefits, they also involve risks related to leverage, counterparty exposure, valuation complexity, and market volatility. A thorough understanding of swaps and options is therefore essential for analyzing derivatives markets, evaluating financial strategies, and managing investment risk in global capital markets.